On January 30th, 2026, silver crashed 31% in a single day. The financial media called it a bubble popping. Wall Street analysts said the correction was overdue. Goldman Sachs told clients to sell. But here's the thing nobody's talking about. While paper silver was collapsing to $78 in New York, actual physical silver in Shanghai was trading at $120. Same metal, same day, 54% price difference. That's not supposed to happen. When an asset crashes, people panic sell the real thing. Premiums collapse. Supply floods the market. But this time, premiums exploded. The paper market and the physical market stopped speaking to each other entirely. And in March 2026, this silent divorce faces a deadline that could break the entire system. Stay with me until the end, because what I'm about to show you isn't just about silver. It's about what happens when the price of something stops reflecting whether it actually exists. Part 1. The crash that wasn't a crash. Let me take you back to January 30th, 2026. If you were watching the markets that morning, you saw something that looked like financial carnage. Silver futures opened and immediately started bleeding. By the time the dust settled, the metal had dropped 31.4% in a single session. That's a $38.15 drop, the largest absolute dollar decline in silver's entire recorded history. The headlines wrote themselves. Bloomberg, silver bubble bursts. The Financial Times called it a long overdue correction. Every talking head on CNBC was nodding along, saying some version of "we told you so." And if you only looked at the charts, it did look like a classic speculative blowout. The kind of thing that happens when too many people chase something too fast and reality snaps back. But here's where the story gets weird. The crash wasn't driven by people suddenly deciding silver was worthless. It wasn't even driven by people at all, really. This was a liquidity event, a mechanical unwind triggered by the plumbing of the financial system itself. It started the day before. Kevin Warsh got nominated as Federal Reserve Chair. Now, if you don't know who that is, just understand this. Warsh is a hawk. He's the guy who thinks interest rates should stay high to fight inflation, even if it hurts. The market took one look at that nomination and repriced everything. Higher rates for longer, tighter money, risk off. Silver had been screaming higher since October 2025. It hit $121.60, a record. People were comparing it to 1980, when the Hunt brothers tried to corner the market and briefly sent silver to $50. But this rally wasn't just speculation. It was industrial demand. It was investment flows. It was allocators finally waking up to the fact that silver supply is structurally broken and price can't fix it fast enough. But all of that takes a back seat when the Fed signals a regime change. Once Warsh's name hit the wires, the algorithmic trading program started doing what they're programmed to do. Systematic funds have rules. If silver breaks below $100, sell. If it breaks the 50-day moving average, sell more. These aren't human decisions. They're pre-coded instructions running on servers in New Jersey, and they don't care about fundamentals. So silver broke $100. The algos sold. That pushed it lower. More sell stops got triggered. More margin calls went out. And here's the kicker. The CME group, the exchange where these futures trade, decided to shift to percentage-based margin requirements, up to 16.5%. Let me translate that. If you're a trader holding silver futures on leverage, you suddenly needed to post way more collateral to keep your position open. Like immediately. Most people couldn't, so they got liquidated, forced selling, and that forced selling pushed the price even lower, which triggered more margin calls, which caused more liquidations. It's a doom loop, a cascade. And by the time it bottomed, silver had touched $78.12 intraday. That's the 50-day exponential moving average, a technical support level that, under normal circumstances, might have held. But these weren't normal circumstances. Thousands of contracts got closed out during that session. Open interest, the number of active futures contracts, collapsed. The leverage speculators, the retail traders who were long on paper but didn't actually own any metal, got completely washed out. Gone. Purged from the system. Meanwhile, the US dollar index surged. When the Fed signals higher rates, the dollar strengthens, and silver is priced in dollars, so a stronger dollar puts natural downward pressure on the metal. Its inverse correlation playing out in real time. The institutional narrative solidified within hours. This was a speculative bubble that had popped. The smart money had seen it coming. Silver would now drift back down to where it belonged, somewhere below $50, where the sober analysts had always said it should trade. Case closed, right? Wrong. Because while all of this was happening in the paper markets in New York and London on screens, something completely different was happening in the physical markets, and that's where the story stops making sense. Part 2. The moment the prices split. Here's the thing about financial crashes. They're supposed to be uniform. If something's truly overvalued and the bubble pops, everyone rushes for the exits. Paper and physical both collapse. In fact, physical usually trades at a discount during crashes because panicked holders dump their coins and bars trying to get whatever cash they can. That's not what happened on January 30th. While paper silver was printing $78.12 in New York, the absolute low tick of the crash, physical silver in Shanghai was trading above $120 per ounce. Let me say that again. Same metal, same moment, 54% premium. In Dubai, wholesale physical premiums hit 18% over the paper price. In Mumbai, dealers were quoting 25% above the screen. In Japan, some trades went through at $130. In Kuwait, $106. All while the futures market was screaming that silver was worth $78. If you wanted to buy actual silver on January 31st, the day after the crash, you couldn't find American Silver Eagles for less than $95 on eBay. That's $17 above the supposed crash low. And if you wanted proof coins like the 2023 Morgan and Peace sets, dealers were asking $180. This is the exact opposite of what happens in a real bubble. When tulip mania collapsed, you couldn't give tulips away. When the dot-com bubble burst, nobody wanted shares at any price. When housing crashed in 2008, foreclosures flooded the market and drove prices into the dirt. But silver, physical silver got more expensive during the crash. The premium widening is the signature. It's the fingerprint of a market that has fractured into two separate realities that no longer communicate with each other. The paper market says $78, the physical market says $120, and there's no mechanism to bring them back together because the thing that's supposed to connect them, arbitrage, has broken down. In theory, arbitrage is simple. If silver's cheaper in New York than Shanghai, you buy in New York, ship it to Shanghai, and sell it for a profit. That price difference gets erased almost instantly because traders jump on it. It's how markets stay efficient. But you can't arbitrage something that doesn't exist. The Exchange for Physical Spread at the London Bullion Market Association, the EFP, which measures the cost of converting paper contracts into actual metal, widened from 25 cents to over $1.10. That's enormous. It means the friction of turning a paper claim into real silver had quadrupled. Why? Because there wasn't enough metal to go around. Dealers were reporting 4 to 6 week delivery times for standard 1,000-ounce bars. That's not a normal backlog, that's a "we're sold out but we'll put you on the list" situation. And large industrial users, the companies that actually need silver to manufacture things, started bypassing the exchanges entirely. They went directly to the miners and paid private premiums to secure supply, because waiting wasn't an option. This is the moment the divorce became undeniable. Paper silver and physical silver stopped being the same thing. They decoupled, and once that happens, the entire pricing system starts to unravel, because the paper price is supposed to represent the physical metal. If it doesn't, what does it represent? The answer is leverage, speculation, contracts, promises, but not metal. Part 3. Why arbitrage failed. So why couldn't arbitrage close the gap? Why didn't someone just buy cheap paper silver in New York and convert it to expensive physical silver in Shanghai and pocket the difference? Because the metal isn't there. Let's talk about how silver gets mined. 70% of the world's silver doesn't come from silver mines. It comes as a byproduct of mining other stuff. Copper, zinc, lead. You're digging for copper, and silver just happens to come up with it. Which means that even if the price of silver doubles or triples, you can't just turn on more silver production. The byproduct ratio is fixed. You'd have to massively expand copper mining to get more silver, and that takes years, decades even. And it's not like there are a bunch of untapped silver mines waiting to come online. The discovery to production timeline for a new mine is roughly 10 years. You have to find the deposit, do environmental studies, get permits, build infrastructure, and then start digging. Even if someone announced a major new silver discovery tomorrow, it wouldn't produce an ounce of metal until the mid-2030s. Meanwhile, demand is eating supply alive. 2025 marked the 5th consecutive year of a production deficit. That means the world used more silver than it mined. 2026 is projected to be the 6th deficit year in a row, and it's getting worse, not better, because industrial demand is accelerating. Where's the gap being filled? Inventories, stockpiles, the metal that's sitting in vaults at the London Bullion Market Association and the COMEX exchange in New York. And those inventories are at multi-decade lows. They've been drained year after year to meet industrial demand, and now there's just not much left. Fresnillo, the world's largest primary silver miner, cut its 2026 production guidance. Why? Declining ore grades. The easy silver has already been pulled out of the ground. What's left is harder to get, lower quality, more expensive to process. You'd think high prices would trigger a recycling boom, right? Melt down old silverware, recover it from electronics, flood the market with scrap. But it hasn't happened. Most silver in modern products is used in tiny amounts, micrograms in a phone, milligrams in a solar panel. It's not economically viable to recover. The metal is effectively lost once it's embedded in a device. So supply is inelastic. It can't respond quickly to price signals, and the supply that does exist is increasingly locked up, unavailable, or already spoken for. This is why arbitrage failed. Arbitrage requires the thing you're trading to actually be movable, deliverable, and available. But if the vaults are empty, if the bars are already pledged to industrial users, if the production pipeline is running dry, then there's nothing to arbitrage. You're just trading promises. And promises don't ship to Shanghai. The physical market knows this. That's why premiums exploded. People who actually need the metal, manufacturers, refiners, large-scale buyers, weren't willing to sell at the paper price because they knew they couldn't replace what they sold, so they held, or they demanded massive premiums, or they refused to sell at all. And that brings us to the geopolitical accelerant that made everything worse. Part 4. The China Lock. On January 1st, 2026, China changed the rules. The Chinese government reclassified silver as a strategic metal. What does that mean? It means you can't just export it anymore. If you're a Chinese company and you want to sell silver internationally, you now need a government-issued license, and those licenses aren't being handed out to just anyone. The new regulations favor large state-run firms. Smaller producers, the independent miners and refiners who used to supply the global market, are effectively shut out. They don't meet the thresholds, they don't have the political connections, they're done. Why did China do this? Because China is building the future, and the future runs on silver. China is the world's largest manufacturer of solar panels, and solar panels are extremely silver-intensive. Photovoltaic cells use silver paste to conduct electricity. The more solar you build, the more silver you need, and China is building solar at a scale that's hard to comprehend. In 2024 and 2025, solar manufacturing alone consumed 25% of the world's total silver supply. China is also racing to dominate artificial intelligence. AI data centers require massive amounts of high-performance computing hardware, GPUs, accelerators, interconnects. All of that uses silver because silver has the highest electrical conductivity of any metal. You can't substitute it with copper in high-speed, high-reliability applications without sacrificing performance. And in AI, performance is everything. So China looked at its domestic silver supply and said, "We're keeping this." It's not about making money selling silver to foreigners. It's about securing the inputs for the industries that will define the 21st century. Silver isn't just a commodity anymore, it's strategic infrastructure. And once a country locks down a critical resource like that, the global market doesn't just adjust, it fractures. Mexico is the world's #1 silver producer, but its mines are aging. Ore bodies are maturing. Production is phasing down, not ramping up. There's no cavalry coming from Mexico. The 6th consecutive deficit year is now locked in. The supply that was supposed to come from China is gone. The supply that was supposed to come from new mines doesn't exist yet, and the supply sitting in vaults is already almost gone. This is the backdrop. This is the structural reality that the paper market refuses to price in. Because the paper market operates on the assumption that if the price goes high enough, supply will respond. That's how commodities are supposed to work. But silver isn't responding. And that brings us to March. Part 5. March 2026. The stress test. March is a delivery month on the COMEX. That's the exchange in New York where silver futures trade. And delivery months are when the math of the paper market collides with the reality of the physical market. Here's how it works. When you buy a silver futures contract, you're not buying silver. You're buying a promise that you can exchange for silver later. Most traders never take delivery. They just roll the contract forward or cash out. It's a paper game. But some traders, especially industrial users who actually need the metal, do stand for delivery. And when they do, the exchange has to provide it. Now, let's talk about the numbers. The COMEX currently holds 108.7 million ounces of silver in the registered category. That's the metal that's available to be delivered against futures contracts. Sounds like a lot, right? Except there are 1.586 billion ounces of open interest. That's the total amount of silver that traders have claims on through futures contracts. Do the math. That's roughly 14 ounces of paper obligations for every 1 ounce of physical silver in the vault. 14-to-1 leverage. Here's the breaking point. If just 7% of contract holders decide they want physical delivery instead of cash settlement, the vault is empty. 7%. That's it. In January, delivery demand hit 40 million ounces. That's already more than a third of the available registered inventory. And January isn't even a major delivery month. March is. Analysts are projecting that delivery demand in March could hit 70 to 80 million ounces. Some estimates put the true free float, the silver that's not already pledged or encumbered, at only 10 to 20 million ounces. If those projections are even close to accurate, the COMEX is going to have a problem. A big one. Because industrial users have to stand for delivery, they're not speculators. They're not playing a paper game. They're solar manufacturers, electronics companies, EV producers. They need the actual metal to build their products. They can't accept a cash settlement because cash doesn't conduct electricity, and this is where the system's blind spot becomes dangerous. Most institutional investors treat silver as a paper asset. They buy it through ETFs, futures, or derivatives. They look at the price on the screen and assume that price represents reality. But they never ask the question, can this actually be delivered? The answer, increasingly, is no. If the COMEX can't fulfill delivery requests in March, they have options. None of them are good. They could force cash settlements, which would effectively admit that the paper price is disconnected from physical supply. That would destroy the credibility of the futures market. Why would anyone trade a silver future if it can't actually be converted into silver? Or they could try to source metal from elsewhere, raid other vaults, negotiate with private holders, pay massive premiums to miners. But that just proves the same point. The metal isn't there at the price the paper market claims. Some analysts are calling this a potential canary in the coal mine moment for the broader financial system. Because if the silver market fails to deliver, it raises a such bigger question. How many other markets are operating on leverage ratios that can't survive a stress test? This isn't speculation about some distant future crisis. This is March 2026. That's weeks away as I'm recording this. The countdown is already running, and while traders are focused on delivery mechanics and vault inventories, there's a much bigger story unfolding in the background. Because this isn't just about investors anymore. It's about the real economy. Part 6. The human cost of a silent shortage. Here's what gets lost when we talk about commodity markets. These aren't just numbers on a screen. They're inputs for the things that shape people's lives. Silver isn't optional anymore. It's not just jewelry or coins or some hedge against inflation. It's a critical industrial material embedded in the infrastructure of modern civilization. And when the supply of a critical material starts breaking down, the consequences ripple outward in ways most people never see coming. Let's start with AI. The build-out of artificial intelligence infrastructure is one of the largest capital expenditure cycles in history. Amazon, Google, Microsoft, these companies are building data centers the size of small cities. Those data centers are packed with GPUs and accelerators and high-speed interconnects. All of that hardware uses silver, because silver's electrical conductivity is unmatched. You need reliability at scale, and silver delivers it. Here's the problem. AI hardware manufacturers are price insensitive. For them, the cost of silver is a rounding error compared to the total unit cost of a GPU cluster. They will pay almost any price to secure supply, because if they can't get the silver, they can't build the hardware. And if they can't build the hardware, they fall behind in the AI race. And falling behind in AI is an existential threat, so they're going to get their silver, no matter what. Now, let's talk about solar. Photovoltaic manufacturing consumed 25% of the world's silver supply in 2024 and 2025, and that percentage is growing because the world is trying to decarbonize at a pace that's frankly out of control relative to the availability of the materials required to do it. Every solar panel needs silver paste. There's no substitute that works at the same efficiency, and global climate goals are mandating solar installations at a rate that assumes the silver will just be there. But it won't. Not at current prices. Maybe not at any price if the supply chain is genuinely broken. What happens when solar manufacturers can't get silver? Costs go up. Projects get delayed. Developing nations that are counting on cheap solar to leapfrog fossil fuels suddenly find themselves priced out. Energy access becomes a luxury. The entire promise of a green transition starts to fray because the math only worked if the materials were abundant and cheap. Then there's electric vehicles. EVs use 25 to 50 grams of silver per vehicle. That's 80% more than a traditional internal combustion engine car, and the world is trying to electrify the entire vehicle fleet over the next 2 decades. Do the math on how much silver that requires, then ask where it's going to come from. Grid electrification is the same story. 5G networks, charging infrastructure, switchgear, connectors, all of it uses silver. The expansion of the electrical grid to support EVs and renewables and data centers is creating a parallel, overlapping demand for the same metal that's already in deficit. This is what makes the silver story different from a typical commodity cycle. It's not just investors bidding up the price, it's the entire technological and industrial base of the modern economy, competing for a material that isn't being produced fast enough to meet demand. And the people who get hurt first aren't hedge fund managers. They're the workers in factories that can't get components, the communities in developing countries that lose access to affordable energy, the small manufacturers who get priced out because the big players can afford to pay premiums they can't. This is the human cost of a silent shortage. It's silent because it's not showing up in headlines. It's not a dramatic supply shock like an oil embargo. It's a slow, grinding tightness that compounds over time until something breaks. And when it does break, it won't be a clean, contained event. It'll be cascading disruptions across industries that most people assume are unrelated, because they're all connected through the same invisible material choke point. So where does this leave us? January 30th, 2026 did not end the silver bull market. It exposed it. The crash was the moment when the paper market and the physical market stopped pretending to be the same thing. The divorce is final. They're operating on completely different logic systems now. Paper silver crashed because leveraged traders got margin called and algorithms sold indiscriminately. Physical silver surged because people who actually need the metal weren't willing to part with it at artificial prices. One market is driven by financial mechanics. The other is driven by supply and demand in the real world. March 2026 is when this fracture gets tested. If the COMEX can't deliver against the contracts that come due, the illusion shatters completely. Maybe they find a way to muddle through, negotiate settlements, raid other vaults, pay premiums quietly behind the scenes. Or maybe they don't. Maybe this is the month when the leverage ratio finally meets reality and the system admits it can't deliver what it promised. I can't tell you exactly how it plays out. Nobody can. But I can tell you this. Silver is undergoing a structural re-rating. It's no longer just a precious metal. It's a strategic technology metal embedded in AI, solar, EVs, grid infrastructure, and defense systems. And the supply of that metal is fundamentally constrained in ways that price alone cannot fix. The Great Divorce isn't just about silver. It's about what happens when markets stop reflecting reality. When the price of something stops telling you whether it actually exists. When leverage and promises and financial engineering create a parallel universe that floats further and further away from the physical world until one day someone asks for delivery and there's nothing there. That's the reckoning. And it's not coming in some distant future. It's coming in March. Maybe it's already here. Because when markets divorce reality, reality doesn't wait for permission. Reality eventually files first. And when it does, the settlement terms aren't negotiable. The question isn't whether silver is overvalued or undervalued anymore. The question is, can you actually get it? And if you can't, what does the price even mean?